Whenever you get a discussion on the dollar versus various other asset classes, you always get immediate answers that, well, a falling dollar should be good for commodities, should be good for gold, and the reverse when you have a rising dollar. But the real question, the other question is, how does it really do with equities? And the answer can actually be varying depending on the time frame that you're actually looking at. And so I'm just going to go over charts of what you're looking at is the Dow Jones index on top. Let me change that color to a blue. And then we are looking at the dollar index at the bottom. I'm just yellowing that. So now we have two colors. And we're looking at way back going to 1970 from where the dollar index data is actually available. Remember 1971 is when the US dollar went off the gold standard. So that's an interesting point, and we actually had the dollar decline during this entire period. The question is, how did equities do? Now, we do know that between this entire time frame to the early 80s, you had very high levels of inflation in the US, and gold prices actually went through the roof. And equities during that entire period essentially remained at a range. You've seen this very sharp sell-off occur, and this has occurred right here in between this period. Of course, while it was occurring, you did see some stability in the dollar, and then it bounced back with the dollar, and then it's actually fallen with the dollar in this phase. So, but on a very broad basis, the entire period was one of a declining dollar all the way down to the early 80s, and during this phase, equities basically remained flat or very volatile. Then in the subsequent phase, we saw strong dollar. Interest rates were actually pushed up aggressively to stabilize inflation, and that went on till the early 80s, closer to this point, and after that the stock market took off and the dollar still continued to rise in the months ahead. So you had a positive relationship between the two, but that continued only up to 1984, and subsequently you see a phase in which the dollar was declining. It was declining into 1992 and remained at the lower end of the range till 1995. Now, even in this phase, we've actually seen equities do even better. So this is the initial rising dollar phase. So they did well, but they did really well in the subsequent phase, though you can say most of it after 1987 was relatively flat, but in general, prices were higher throughout this time period as well. And then we move into the next period of dollar rally, which went all the way into 2002. This was an interesting period essentially because of the impact it had on emerging markets. You had the Southeast Asian crisis and various other dollar crises in this period. It meant nothing for US equities because US equities simply continued to do well even in this rising dollar environment. And the impact was more on other economies around the world, but not on the US itself. Okay, and this was an interesting point because the tech bubble essentially burst by early 2000, somewhere here at this point. The dollar was still rising. It rose all the way into late 2000 and rather, let's say this is the highest point. So it's into mid of 2001, which means closer to, I think, when you had 9/11. So this is June 2001. The last high point is in somewhere to 2002. So let me just zoom in for a second and see which was the highest point. It was in 2002. So that's true. By end of 2001 is where you saw the dollar peak, and from there on, even as equities were in the late stages of the tech bubble bear market, which was from here to here, and then the dollar started falling, and this entire phase was then associated with rising emerging markets and the falling dollar and rising commodity prices. So now you had this entire phase from 1984 all the way to 2001, in which the dollar did fall and did rise, but this fall was not associated significantly with a commodity rally. You may have had a mild rally, a retracement of the initial decline, but not the runaway boom that we saw in the 2000s. And then this phase, commodities were still down. But in both these phases, equities continued to do really well. It's only subsequent to that, when this dollar fall was associated with starting of the commodity bull market, and even as the dollar rallied and pulled back to this initial higher bottom, commodities made their highest point here in 2011. Uh, so how did equities do in this? Equities did rise with the falling dollar initially, and then they declined sharply once the dollar had bottomed. So let me put a vertical line at the point that the dollar did bottom again, which is in 2008. So in 2008, we got the dollar bottom and a turnaround. The initial turnaround caused equities to decline. The latter turnaround has caused equities to essentially uh, rally right from here all the way to here. Now you can argue that within this phase, this part where the dollar actually went up is where the crash happened, and most of this phase, while there were up down movements, in general the dollar was in a trading range, and so you didn't get much impact all the way till here. And subsequently, as the dollar has rallied strongly, have we really seen the kind of crash that we saw in 2008? Not in US equity, but only in equities around the world that we've seen that kind of a sell-off. So the point here was to whether to associate this with US equities. So what we essentially see is that the rising dollar does have a strong impact on global equities, which is non-US. It had that impact between 1992 and 2001. Not initially, but in the latter half, once we got past the midway point of that rally, by 1998, you had an Asian crisis, and later things did improve due to stimulus. But eventually, as the dollar still moved higher, you had the 2000 top across the world, and things were pretty good when you had the falling dollar for the rest of the world, but not necessarily always for the US. US actually underperformed world equities during the falling dollar phase here, which is very similar to what it would have done maybe in the 70s. At least US equities remained down to flattish throughout that phase. So what you've essentially got once again is a rising dollar from 2008 to 2015, which has essentially not been very good for world equities, neither in 08 and not in the subsequent period after 2011 or after 2014. It actually hurt a lot of world equity markets. But it did not do that much damage to essentially the US. Now, what conclusion should you draw from this? One possible conclusion is the rising dollar is essentially associated with, fair control over inflation as far as the US is concerned, and in that sense, it's actually aided the growth cycle. And while it's also been associated in the 80s with the rising interest rates in the initial phase, the subsequent phase, we saw even as interest rates went down, the dollar was still rising as probably money poured into US equities. So essentially, it brings back to the same point that free floating currencies essentially reflect capital flows. And whenever the dollar has risen, there have been capital flows into the US. But because the US dollar is the reserve currency of the world, or has become so, every time you have a rising dollar, it creates a crisis for many other parts of the world, not necessarily the US. And whenever you have a falling dollar, it actually aids other parts of the world, or at least creates some inflation, which can be a little detrimental to the US itself, but or at least causes lower returns in US equities, uh, and does create some amount of inflation. So, what are we looking going ahead? Of course, it's a discussion. My essential view has been that probably the best part of this dollar run is done, and the reason for that was that even though it's broken out of this falling trend line, which a lot are taking to be a long-term turnaround, what I'm watching is the 61% retracement of this entire decline, and we've stopped right there. And unless we get past that, this could essentially end up being a false breakout, maybe even a top in the dollar, and then we would actually be looking at a falling dollar scenario. Of course, the trend is not completely reversed. It may still be forming some kind of pattern in here, a triangular pattern. Uh, and once that pattern is complete and we get a breakout, it would probably confirm the bullish or bearish opinion on the dollar going ahead from here. Uh, uh, but it's pretty apparent right now in the current environment, just like in the late 90s, that rising dollar essentially is not helping the rest of the world. The Fed is already saying that we don't want that, and which is why we could end up with a weaker dollar and more inflation, which is essentially what the Fed has been trying to create over the last many years and might eventually get some of it. The big question is, would that be good for the US in an environment where interest rates are down to zero? Uh, High levels of inflation would mean higher interest rates, and that would be a very different headwind from what it has been in the past. Say, for example, the early 80s, and that's what the quantitative cycle is all about. The quantitative cycle explains that the quantitative summer, essentially a period when debt levels are not at their highest in the historical cycle. They're high but not at their highest. Rising interest rates used to curtail inflation actually works well. It consolidates the economy and then eventually allows, once inflation comes under control, allows for a period of sustained growth, which is what we saw through the 80s subsequently. And in India, we saw a similar phase during the 1990s. We had very high rates of inflation and interest rates. Interest rates peaked in the 90s, and since then they've declined sharply into 2001, 2002. They may have moved up, but never gone back to the highs that we saw in the 90s. And essentially, when you have very high levels of debt, you cannot do the same, because while you can wish for some inflation, if you get too much, raising interest rates in a highly leveraged economy can cause other problems which would not have happened in the quantitative summer phase. So the next dollar decline will be far more interesting than the one that we saw probably in the preceding two periods, which is the 80s, that continued to inflate the world economy, and in the uh, 2000s, which actually helped a lot of the emerging world, and also provided stimulus to the US economy. At that point, the next time the dollar falls, we would be looking at high levels of inflation and interest rates in an environment where debt levels are the highest that we've ever seen in recorded history. So it's all in this video update. Thank you.